Carol, thank you so much for joining me on the heels of Investor Day. You're joining us from Worldport in Louisville, Kentucky, which processes 400,000 packages per hour. When we talk about this 2026 forecast, revenue of $108 to $114 billion, that's up from $91 billion last year. Adjusted operating margin above 13% for 2026 as well. These are well above street expectations. What gives you the confidence to put this forecast out, especially as we have had a very challenged market for freight and small package?
Well, Morgan, I'm delighted to join you today, and thank you for your questions. We're excited about the future, and let me make it real for you. In our growth forecasts, we're leaning into healthcare logistics in a meaningful way. In fact, we declared today that we want to be the #1 complex healthcare logistics provider in the world. Last year, our healthcare revenues reached $10 billion. We plan to double that by 2026. So that's $10 billion of growth over the next 3 years. And the wonderful thing about healthcare is you find it in all three segments, in our domestic segment, in our international segment, and in our supply chain segment. But it doesn't stop there. We see opportunities for growth outside of the United States. The premium market is $50 billion. We've got lots of room to grow in that area. And coming back to the U.S., the good news about the U.S., after the small package market shrinking in 2023, it's posed to return to growth in each of the next 3 years. So when we add it all up, we're confident of the numbers that we've shared.
Okay, and I do want to dig into some of those areas of growth a little bit more. But first, this 1+2 plan to grow volume by volume by dollar, then to grow volume with a focus on margins. This seems to be, at least according to some of the analysts we've spoken to, what's putting shares of UPS under pressure today. Walk me through the strategy and what, at least initially, investors might be missing here.
Well, 1+2 is simply based on the cost nature of our new Teamster contract. And you may recall we negotiated the largest Teamster contract in the history of the United States last year. We're very pleased with that contract. The compounded annual growth rate of the wages and benefits is 3.3% over a 5-year period, but it is front-end loaded. So 1+2 is simply this. In year one, we want to grow our volume and our revenue and our operating profit dollars. And then in years 2 and 3, we want to grow volume, revenue, and operating profit margin. Why will margin expand past year one? Because we are going to anniversary the first year of the Teamster contract in August, and the cost growth rate, well, it drops dramatically after that. So we plan to exit the U.S. with an operating margin of 10% this year, which gives us a jump pad to reach 12% by the end of 2026.
So what does that enable in terms of future cost cuts and, just as importantly, future investments in the network? When you've realized almost half the cost associated with this 5-year contract in year one, how much more flexibility does that give you in terms of how you want to drive the changes within the network?
Yeah, this is one of the most exciting initiatives we have facing UPS over the next several years. You know, this is our 117th year in business. The network, it's old. It's integrated. So we have the highest margins in the industry because of the integrated nature of our network, but it's old. And so with Network of the Future, we are reimagining our network. We're leaning in automation into ways we never have before. And imagine, we're talking about automating every aspect inside of the buildings. We're also going to collapse some buildings that we don't need any longer into larger, more automated buildings. We will invest to make this happen. We'll invest about $9 billion over 5 years. But in that 5-year time frame, we will enjoy $3 billion of savings, of which 50% will be recognized in the first 3 years.